In September 2025, the Federal Reserve cut interest rates for the first time in 4 years, and the entire internet lost its mind. Every finance creator on the planet published the same video telling you to dump your money into the S&P 500 because rate cuts make stocks go up. That was the advice. Buy the index fund, sit back, and get rich. 6 months later, the S&P 500 is down almost 3% since January. A war in the Middle East is sending oil prices past $100 a barrel, and the Fed has frozen rates in place with no clear plan for what comes next. The people who followed that advice in January are currently watching their first $1,000 shrink on a screen while gas prices climb toward $4 a gallon. So if the old playbook is broken, what actually works for your first $1,000 right now, in 2026, in an economy that nobody predicted? That is exactly what this video is going to answer. I have to disclaim that nothing in this video is financial advice. I am not a licensed advisor, and your situation is yours. Do your own research, talk to a professional if you need to, and never invest money you cannot afford to lose. Let's start with what happened, because if you don't understand the economic shift, you'll keep making the same mistake everyone else is making. In late 2025, the Federal Reserve cut its benchmark interest rate 3 times in a row: September, October, December. Each time they sliced off a quarter point, bringing rates down from around 4.5% to 3.5%. The logic was straightforward. Inflation had cooled off, the job market was softening, and the economy needed a little breathing room. Wall Street celebrated. Stocks rallied hard through the end of 2025, with the S&P 500 finishing the year up over 20%. Money was flowing, confidence was high, and every headline screamed the same message: rate cuts equal easy money. But then, 2026 arrived, and 3 things happened that almost nobody had on their bingo card. First, inflation stopped falling. The Consumer Price Index for February 2026 came in at 2.4%, which sounds low until you realize the Fed's actual target is 2%. They've been stuck above that target for nearly 5 years now. Core inflation, which strips out food and energy, sat at 2.5%. Translation? Prices are still rising faster than the Fed wants, and they can't cut rates further without making it worse. Second, the conflict in Iran sent oil prices through the roof. Crude briefly spiked above $100 a barrel, and gasoline hit $3.50 a gallon nationally, up nearly 60 cents in just 2 weeks. Higher oil doesn't just mean expensive gas. It filters into shipping costs, food prices, airline tickets, and basically everything you buy. Some economists estimate that if oil stays elevated, headline inflation could climb back to 3.5% by December. Third, the job market quietly started cracking. Fed Chair Jerome Powell himself said in March that job creation had slowed to essentially zero, not negative, but not growing either. When hiring freezes but prices keep climbing, you get the worst combination for regular people. Your cost of living rises while your income stays flat, so the Fed is stuck. They can't cut rates because inflation is still too high, especially with oil adding fuel to the fire, but they can't raise rates either because the job market can't handle it. At their March 2026 meeting, they held steady at 3.5 to 3.75% for the second time in a row, and their own projections show maybe one more cut for the rest of the year. Maybe. This is the environment your first $1,000 is walking into, and it demands a completely different strategy than what worked 12 months ago. Here is the framework, and it has 3 layers. Think of it as a pyramid. The base keeps you safe, the middle builds wealth slowly, and the top takes advantage of what 2026 specifically offers. Layer 1 is the foundation, and it is boring on purpose. Before you invest a single dollar, you need a high-yield savings account. As of March 2026, the best accounts are still paying between 4 and 5% annual interest. That is not a typo. You can earn $40 to $50 a year on your first thousand with zero risk because these accounts are FDIC insured up to $250,000. Here is why this matters more than usual right now. When the stock market is volatile and nobody knows whether the Fed will cut or hold or even raise, cash in a high-yield savings account is not lazy. It is strategic. You are being paid 4% or more to wait while the market figures itself out. If you don't already have an emergency fund, your entire first $1,000 belongs here. Full stop. Investing money you might need next month is not investing, it is gambling. But if you already have some emergency savings and this $1,000 is money you can genuinely afford to lock away for 5 years or more, then we move to Layer 2. Layer 2 is the Broad Market Index Fund, but with a crucial adjustment for 2026. The standard advice has always been to buy a total stock market index fund or an S&P 500 fund, set it and forget it, and let compounding do its thing over decades. That advice is still fundamentally correct over long time horizons, but the timing of when you buy matters more than people admit, and right now there is actually a silver lining hiding inside all this chaos. The S&P 500 started 2026 at around 6,845. As of late March, it has dropped to roughly 6,477. That is a decline of about 5% from the peak. For a long-term investor with a 5 to 10-year horizon, buying during a dip is exactly what you want. You are getting shares at a discount compared to the people who bought at the top in December. The key phrase here is long-term. If you need this money in 2 years, do not put it in the stock market. Period. But if you genuinely will not touch this money until 2031 or later, buying a low-cost index fund while the market is down is one of the smartest things you can do with $100, $200, or even $500 from that thousand. Now, a lot of people will tell you to just buy VOO or VTI and call it a day. And honestly, that is fine. But 2026 offers a reason to think slightly broader. International stocks have actually been outperforming the US market this year. Emerging markets are up almost 5%, while the S&P is down 3%. A total world index fund gives you exposure to both, which means you are not betting everything on the American economy recovering first. Diversification sounds like a boring textbook word, but in a year where the US is dealing with a war, stubborn inflation, and political uncertainty around the Federal Reserve itself, spreading your bets across the globe is less about theory and more about common sense. Layer 3 is the 2026 specific opportunity, and this is where it gets interesting. Remember those 3 rate cuts from late 2025? They did something important that most people are ignoring. They made bonds attractive again. Not the boring kind your grandparents talked about. I mean short-term treasury bonds that the United States government guarantees. Right now, a 2-year treasury yield is sitting around 3.9%. A 10-year treasury is paying about 4.4%. These are rates we haven't consistently seen in almost 2 decades. And here is the part that matters for your first $1,000. If you buy a treasury bond or a treasury bond ETF today and the Fed does eventually cut rates later this year, the value of your existing bonds goes up. Bond prices and interest rates move in opposite directions. When rates drop, the bonds you already own become more valuable because they are locked in at the higher rate. So you are getting paid nearly 4% while you wait, and if a rate cut happens, you also get a bump in the price of your holdings. It is one of those rare situations where you get rewarded either way. If rates stay the same, you collect the interest. If rates drop, you collect the interest and the bond price rises. For a $1,000 investor, The simplest way to access this is through a short-term Treasury ETF. You can buy shares for as little as the price of one share, which is usually somewhere between $70 and $100. No minimums, no complexity, just government-backed debt paying you to hold it. So let's put the full picture together for someone with exactly $1,000 in 2026. If you have no emergency fund, all $1,000 goes into a high-yield savings account, earning 4 to 5%. Build that safety net first because no investment strategy survives an unexpected car repair or medical bill. If you already have some emergency savings, consider splitting it, maybe $400 in the high-yield savings account as extra cushion, $300 into a broad index fund while prices are discounted, and $300 into short-term treasuries to capture that 4% yield with potential upside if rates get cut later this year. The exact split depends on your situation, your age, your risk tolerance, and how soon you might need the money. There is no single perfect answer, and anyone who tells you otherwise is selling something. But here is what I want you to take away from this. The 2026 economy is not the 2025 economy. The advice that worked last year is not the advice that works today. Rate cuts already happened, the easy gains already got priced in, and now we are in a holding pattern with real risks on multiple fronts. Your first $1,000 deserves better than a strategy built for a world that no longer exists. It deserves a strategy built for right now, with high-yield cash as your anchor, index funds bought at a discount, and treasuries as your hedge. That is the Post-Rate Cut Playbook, and it works whether the Fed cuts again, holds steady, or does nothing for the rest of the year. If you want more videos like this, be sure to hit subscribe. I will see you in the next one.